But because I thought Roman Haas would, in Dow Chemical, would stick to the deal, selling the company for $78 a share, then it was fairly a small risk to take to go long the stock using this synthetic stock position by purchasing a call and selling a put at the same strike price. Let's go over to the risk profile just for a second, and I'll show you how this works. Let's take the SPY again, and I'll go to the January 12 options, look at the chain, and let's go, if we think the market's going to bounce back, we'll go long a call and we'll short the put. And let's go over to the risk profile, and you can see that it has almost a perfect 100 delta. It's 99.5. The Vega is very low. There's very little volatility in this position because you're basically mimicking a stock purchase. Theta is fairly low. It's only 90 cents a day. And gamma really doesn't come into play until we get close to expiration. But it's that's why they call it a synthetic stock position, because you're basically, if you buy one call and you sell one put, you're basically long 100 shares of the stock, and you have the risks to the downside as well as the profit participation on the upside, dollar for dollar for every move in the SPY. If you see in the announced in the news that some company was going to buy another one at a certain price per share, and it's trading pretty close to that buyout price, there isn't a whole lot of risk by buying a put on that position. You do risk the entire price of the put that you purchase, so I do not suggest that you load up on them. But it is definitely a trade that comes along a few times a year, and if the deal falls through, the stock that is being bought out is going to get murdered in the marketplace, and it would be a pretty easy thing to pick up some pretty quick profits there. The other thing is that if a deal does not go through, in the case of Roman Haas, when Dow decided they were going to start backing out of the deal, and Roman Haas ended up suing them to complete the transaction according to the original deal. And eventually Dow was able to find the financing it needed to pay cash for the company, and the deal actually did go through. Let's recap this strategy. Basically, if there's an announcement made that a company is being bought, they will announce the price of the shares that they're purchasing the company for. And if the market opens very, very at that level or near that level, then it's probably a safe bet at that time to purchase a put. Like I said, don't load up on them, but purchase a put just in case the deal does not fall through. There could be quite a bit of volatility coming into the market, and you'd participate in a hugely profitable situation if the deal does start to fall apart and the shares start to trade back down to its former levels. You are risking the full amount of your put premium, however. But purchase a put rather than sell a call. If you sell a call, you're in danger of having an unlimited loss. At least with the purchase of your put, your only liability is the actual purchase price that you paid for that put. The second strategy is, if it does fall apart and volatility skyrockets, you can go in and purchase a synthetic long position, which is the purchase of a call at the money and a sell of a put at the money at the same strike price. And you have a synthetic long position for very little margin that will allow you to participate if the deal does come back together, to participate once again on the upside. Imagine the investors who are holding onto the stock here at 44, 45, just thrilled that they got a bid of $78 for the share, and all of a sudden the deal falls apart and you're back down to 47. And especially those investors who are thinking about investing in Roman Haas but never did, they got a second chance right here when the stock fell back down to around the 48 level. In the advance, if the deal does in fact go through, and your risk on that trade is to set a stop loss below the previous low that the stock has been traded at. In this case, at 44.13 would have been a logical choice. If it dropped below 44.13, you'd want to get out of that position. You are participating in that stock 1 for 1, so each dollar that the stock advances, you also have a profit of $1 for each share that you had. All right, in the very next video, we're going to be talking about how to participate in a long position when volatility is low. I just gave you a way to participate in a long position when volatility is high, because when we entered this position, the implied volatility was 166% with the synthetic stock position. In the next video, we'll talk about how to participate in an advance when volatility is low.